Silver just had a historic crash that people will be talking about for decades into the future.
Gold and silver prices continued to fall after an historic crash.
But what caused this historic crash? Was it the Federal Reserve and central banks? And what do I think the price of silver is going to do next? I'm going to reveal the answer to these questions in one simple, fast step. Step number one, let's go over this unprecedented move in silver and in the precious metals, but we're going to focus on silver today. And that's not just George Gammon saying that. Most of the experts are coming out and saying that we haven't seen anything like this in silver since the Hunt brothers tried to corner the market in 1980. But let's start by looking at a chart, today's date going all the way back to September or so. So about a 6-month chart of silver. We go from 40 bucks up to 110. Now, we just keep humming right along here. Very, very healthy bull market, but all of a sudden we get to about January 2026 and things go completely parabolic. And I talked about this on my last video where I predicted correctly that we would see massive amounts of volatility in the silver price. Now, at the time, I didn't think we'd see this much volatility. That's for sure. But that prediction definitely came true in spades. So just last Friday, we see this huge down move in the price of silver. In fact, editor, make sure you're throwing up the candlesticks, because that's when you get a visual representation that really illustrates how extreme this price action really was. When we go back to 2025, you see these little teeny weeny nice little baby candlesticks, and then we get to 2026 they're like this big, and the price movement intraday is just swinging back and forth, 14, 15, 20%, who knows. But then unfortunately we get the Wile E. Coyote moment here. The mother of all crashes. And then the next day, it goes down even further. But today, it's up, demonstrating just that massive volatility that I predicted in my whiteboard video last week. And oh, by the way, at the end of this video, I'm going to reveal what I'm doing with my own personal portfolio and a strategy I just used to make a 10% plus return in the last 24 hours. It really has to do with this. This is the key. I noticed these huge gaps. I noticed the candlesticks we were talking about. Noticed the volatility, and I implemented a strategy to take advantage of that. And again, I'm going to go over that at the end of this video, so make sure you stay tuned. But the big question that everybody's asking is, was this historic crash and the volatility a result of the central planners manipulating the price? The Federal Reserve stepping in there and selling all of these contracts short into the market to artificially bring down the price and bail out the banks who had all these short positions themselves on the price of silver. I'm going to give you my answer to that question right now.
So, yes, in my opinion, the Fed did cause the historic crash that we just saw, but not in the way you think, not really through market manipulation. I think it was caused by the Fed indirectly, not necessarily directly. Let me show you what I'm referring to. Let's go back in time. And I'd like to go back in time to late 90s to long-term capital management, but we just fast forward to 2008 because that really gets to the gist of what my point is here. Look at this, the biggest bailout at the time in U.S. history. We bailed out Bank of America, J.P. Morgan, Wells Fargo, Goldman Sachs, Morgan Stanley, Citi, GM, AIG, Freddie Mac, just to name a few. And these were just the direct bailouts. I mean, indirectly, obviously, there were a lot more that you couldn't even fit on this list. So now let's think about the message this sends to the market, or the message this sends to the big banks on a move forward basis after the GFC. So put yourself in the position of a bank. Well, knowing that the Fed is going to come in and bail you out if you take way, way, way too much risk, then what are you going to do? Well, you're only going to lend to institutions that are going to get bailed out. Because why would you lend to a little guy? Why would you lend to a small business or a mid-sized business in the real economy when you could lend to a mega financial institution that's just going to go out there and buy their shares back with little to no downside? Because you know the small guy and the mid-sized guy, they're not going to get bailed out. But the big guy, the mega corporation, they will definitely get bailed out if the stuff hits the fan again. So it was just a rational decision. I'm not saying I agree with it, but it was a rational decision based on the incentives that were produced by the Fed and their bailouts. And the Fed, I'm talking about the central planners. So this naturally increases the risk-taking in the financial economy. And the increase in risk-taking, well, that means the tide is going in further and staying in longer. Well, what does that mean? That means there's going to be more people swimming naked when the tide goes out. And the more recent term for people swimming naked are cockroaches. The cockroaches, we started to see them come out, all these companies that went bust in these financial institutions in 2025. But what most people don't realize is we had the first cockroach go bust in 2026, the day that silver crashed. Let me show you what I'm referring to. Right here, failed bank, Metropolitan Capital Bank and Trust, Chicago, Illinois. Now, I know this is a very small bank, call it $250 million in assets or so, but the point is it was just another cockroach. So for the moment, everyone had forgot about them. Oh, the risk? Oh, that 2025 stuff? Oh, tricolor? Oh, yeah, that's in the past. We can go ahead and look into the future, where the future is so bright, everyone's got to wear shades. In fact, the future's so bright, I'm going to buy all of these assets, including silver, and if I'm a financial institution, I'm going to buy that using leverage and more leverage and more leverage. And what happens is they get over their skis, and this one cockroach, even though it's small, reminds them that they're taking way, way, way too much risk. They sell, and the massive selling begets more selling, and you just have this waterfall, kind of a downward spiral, a self-perpetuating downward spiral that leads to this catastrophic, historic crash that we saw in precious metals, and especially in silver. Now, I'll admit this is a very contrarian opinion. Most people think the catalyst was really Trump selecting someone out of all the doves, for the Fed chair, selecting someone that was a little more hawkish. And they point to the precious metals going down and the dollar going up. But to me, this doesn't make a lot of sense. Why? Because if you look at the 2-year Treasury on that date, the yields went down. And if the market was worried about a Fed chair that's going to be hawkish, you wouldn't have seen the yields on the 2-year Treasury go down. You would have seen them go up. So again, my view is that what we saw was more so a result of the market seeing more cockroaches and less a result of Trump picking a Fed chair that is perceived to be a little more hawkish, although we all know what he's going to do. He's going to drop interest rates as fast and as soon as he possibly can. So I don't think the Fed caused the crash by selling paper contracts artificially into the market. I think they caused the crash indirectly by all of these bailouts, creating all of the incentives and all the additional risk in the financial economy, producing the cockroaches that when those cockroaches go bust, they create turmoil and panic in the market, very similar to what we have seen in the precious metals space.
Now let's talk about how I'm playing this in my own personal portfolio and a new strategy I just used to make over a 10% return in the last 24 hours. So most of you know what candlesticks are and the charts and the technical analysis, but for those who don't, what we saw the other day, and editor, go ahead and throw up a chart, please, so the viewers can follow along, is we saw that huge down candlestick, but then we saw another down candlestick the next day, like I was saying. But what happened is we opened the day right here. So whenever you look at a red candlestick, that implies that the close is lower than the open, and the green is obviously the opposite. So what we had just the other day was an open up here. But intraday, you can see what the price did by these lines at the top of the rectangle. So it went all the way up to here, but it went all the way down here, and it did that late in the day. So let's just say after lunch, I forgot exactly when it was, but after lunch, the price, let's say, is maybe right around here, something like that. Everyone's like, oh my gosh, silver's gonna go down forever, the sky is falling, oh no, sell, 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 sell. And the price goes all the way down here. But then later in the afternoon, as we're getting closer to the close, everyone changes their mind. And I'm talking about the marketplace. And they're like, no, 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 the price of silver is way, way too low. Oh my gosh, buy the effing dip, buy the effing dip. And then it goes all the way back up to here to where it closes right around this mark. And this is just general editor. Again, throw up the exact chart so people can see what I'm referring to. But all of this buying volume that we had to have to bring the price from here to close up to here, I thought would continue into the next day. Because let's not forget, just a couple days earlier, we hit a high at $120 an ounce. So I don't have this represented on the chart. And by the way, the chart the editor is throwing up is just the SLV, the ETF or the Silver Trust. We're just using it as a proxy for the price of silver, where this chart is actually the futures price. I want to make sure there's no confusion there. But the close got up to right around $72.40 or 50 cents, if my memory serves me right. So going into the close, I took a long position in the SLV. So then overnight, what happened? Silver absolutely skyrocketed again, that volatility that I predicted. And when I woke up, my long position was up by about 10%. So then what I did is I went ahead and put a stop in, let's just say, well, it was way up here, but I put 2 stops in. So at the time, the SLV, which I purchased, was trading right around 79. So I put in a stop at 78, and I put a stop in at 80 as well. And then I went on my business because I really didn't have much time to pay attention to the position and kind of manage it throughout the day. Then when the market opened, the price went straight up, thank goodness, and I sold automatically because I had put in that pre-order at $80. So I got in, let's just say right around 72.50 or so, 72.60, and then less than 24 hours later, it was up to $80 where I sold. So up over 10% in less than 24 hours, not bad for an amateur. Now, to be clear, usually I don't make these super short-term trades. I just saw what I thought was a pretty good opportunity based on the probabilities. Now, this is not investing advice. This is not trading advice. This isn't advice of any kind. I'm just sharing with you what I did over the last couple days and what I'm doing with my own portfolio. Now, if you want more insights just like this and contrarian strategies that have worked extremely well, you can check out Rebel Capitalist Pro. This is the investment site that I have with my good friends Chris McIntosh, Brent Johnson, Patrick Sresna, Jason Hartman, just to name a few. And in Rebel Capitalist Pro, I give our members real-time trade alerts. So any move that I make to my portfolio, including this move where I made 10%, my members would have known about it immediately and they could have followed along if they so choose. If you want to check it out, put a link in the description below.